What a time, as the saying goes, to be alive. The coronavirus correction toppling the S&P 500 some 36% peak to trough, redefining what corrections can, dare I say, will be. And this surging bear rally we've seen from the March 23rd swing low that I feel sentimentally has gone way further, way faster than almost anybody expected. The traditional playbook, of course, of a corrective environment involving a retest of the lows, in many cases undercutting the lows, shaking retail hands out before proceeding higher. And where did we find ourselves last week? Some 6 weeks later, off the swing low at the 61.8% Fibonacci retracement from the high, something I saw talked about everywhere in finance, everywhere on Wall Street. Skeptics like my good friend Alex Bernal, affectionately and yet derisively observing the occurrence, while proponents would say the 61.8% retracement is a natural, logical place for a bear rally to go. Now, many of you know for years I've been a student, proponent, defender of fibs, but especially over the last 2 years or so as our exploration into edge has gotten deeper and more sincere, it's led to the discovery of things we consider to be much more meaningful to modern markets than just fibs, than fibs alone. The year is 2020 in modern capital markets, and if you're under the impression that last week's swing high, as institutions deployed capital and supply finally emerged, was the result of a 61.8% Fibonacci retracement, I'm going to invite you to take a little walk with me. My name is Tim Parker. I go by Autumn, and this is your week in Confluence, Episode 2, The Anatomy of a Swing High. So why did the market turn around where it did? Why not sooner? And why not from higher? Why specifically did it turn around where it did? What are the specific answers to specific levels that the market respected this week? Everybody comes into this week, whether you're looking to take profits, you bought the lows, you bought the corrective lows, good job, or you're babysitting a long-only portfolio, or you're looking for a short setup. Every market participant is coming into this last week, the last week in April, looking for the sell. Where are other people going to sell, and where should I? So, as a refresher, guys, the key theme or concept that we're looking to address in these little episodes is confluence. So, building the case for and against high-quality, high-risk-reward trades the way a lawyer would, with multiple pieces of evidence. And there's kind of these two main ways you can think about confluence. One is multiple levels in one instrument. Maybe you're just focused on one thing or a handful of things. Multiple meaningful levels you can build the case for, a long or a short. Build the case for putting some risk on at a specific place instead of just watching one or two things. And then particularly and most powerfully, where this stuff gets really supercharged and kind of magical, is if those levels all set up across multiple instruments or many instruments in the same or similar moment in time. So lots of instruments that all have a relationship, like different parts of the stock market or different risk on and off assets, all at their meaningful levels. Zoom out a bit, look at one moment in time. This is where you get these really kind of powerful confluential signals. And we saw that this week. So while everybody was focused on this fib, this Fibonacci level I sort of made fun of in the intro, the market was actually digesting and interacting with really key levels in the dimension of space, really key levels, lines, structural areas. This confluence signal really played out over 2 days. Most of the market made a high on Wednesday, particularly after hours on earnings. Wednesday evening was a big earnings night, as obviously was Thursday evening with Apple and Amazon reporting. That's, guys, that's the market right there in the year 2020, those two stocks. But the NASDAQ took a little later, making most of its highs on Thursday, again, as the market digested earnings on a lot of NASDAQ stocks on Thursday. So I'm going to cover this 2-day confluence signal that played out, really over 2 days, really Wednesday, but kind of over 2 days, and just tackle the week as it built up, cover a bunch of relevant examples, including individual examples that I'll go over after the confluence sell. Again, why did the market turn here and not before and not wait till higher? Let's take a look under the hood. So it's Wednesday morning, April 29th at the S&P futures. About an hour before open, 8:30 Eastern, the E-mini S&P futures finally hit that 61.8% retracement. And this is what the SPX weekly chart looked like in real time that morning, about an hour before open. Markets are ripping into the 61, and you start to just ask yourself, and the too long didn't read here, or the really key thesis here is a bunch of really powerful levels were waiting just modestly higher than the 61. So while at least in my world, maybe it's my cone of silence, but a lot of people were focused on the 61.8 when really all the key strategic levels in so many things were just a little bit higher. I'm talking almost everything in the market with a key level just a bit higher. So Wednesday, going into the open, this is what the SPX, and you can see we start to build the case for and against, do we short the open on Wednesday, or what are we waiting for? Where do we want to get, where do we want this layup, this home run short, or where do we want to take profits on a long portfolio? So what you're looking at there is, first of all, you can see the 50 weekly EMA is the black line there across your screen, and then the red line is weekly close. Many of you may be familiar with the back tests on weekly gaps, untested weekly gaps in trending instruments when they are trending, some powerful stuff there. But so just above the 61, you start to build the case with a weekly gap fill in the S&P 500 and the weekly 50 EMA, a lot more at that same level, which we'll go into, but that's where the conversation starts. So we look at that Wednesday in SPX here in my NinjaTrader, and you can see on Wednesday we held the open nicely. We didn't fade, and we just kind of grinded up all day. And where did we go? Right to weekly R2. And what else was there? That weekly gap fill I just talked about on the weekly chart of SPX. So now what I'm going to do here is just take a look at this session here. It's the March 6, 2020 session. The untested closing value there, 297.208. And all I'm going to do is draw a little horizontal ray down here on my daily chart at that level. Just a little horizontal line at the untested weekly gap fill, the untested closing value, 297.208. And what's really cool is a globalized feature here in NinjaTrader. It's going to allow that line to show up here if you guys look on my 5-minute chart. So see this line up here was globalized from this close down here, and now it's up here on the higher time frame chart. And what you'll notice predominantly there is we also have annual pivot point. Can't overstate what a big deal that is. That is a big level. Now you see on your screen here we didn't end up testing that in the cash hours. In other words, you can't see an interaction with this huge level, annual pivot point and the weekly gap fill in cash, but it did happen, and I will go over that. Really cool, this globalized feature in Ninja, guys. If you get a chance to try out this Ninja platform, they have a free version. It's just a really dynamic platform. This is the same thing a lot of you have seen us talk about, supply and demand levels. This is the same thing we'll use if we want to map, let's say, an important level, a potent level on the daily chart here. You can see me draw a little horizontal region on the daily chart, and it will show up on the actionable time frame. So whether that's a 1 minute, a 5 minute, or a 15 minute, you can interact with these levels, draw them on whatever time frame you're using to map them, and they'll show up on other time frames. In fact, they'll show up on every chart. So you guys can't see my 7 other screens here, but everywhere I have SPX, the S&P 500 represented, all of these globalized drawings that I'm depicting here is going to show up on all of them all over my other screens. Very useful. So this is Wednesday. Again, SPX comes up into weekly R2, and as we start to come up and we're starting to map these levels higher, we also have the context hypothesis or the context queue of earnings. So SPX closes right after a modest fade up from its weekly R2, and Wednesday after the close, you're keeping in mind in real time there's a bunch of earnings, and then the next day, Thursday, Apple and Amazon reporting, and Wednesday a bunch of things come up into very meaningful levels. SPX here at weekly R2, you can take a look at IWM on Wednesday as well. That Wednesday high is its weekly R4. Right there. Even Apple that afternoon ended up going higher. Obviously some exogenous stuff on earnings, but it did have a great level on Wednesday at the highs with, let's see, this is weekly R1 right there. And what else was there at that same level was, if you look here, there's an untested close. This This session, March 6th, untested closing value, so a gap fill. In other words, 289, just over 289, so we can just draw a little line there and have that value ready for the day. That's right there. And so you can see now you're building a little Confluence case in Apple, even if you're just trading this one stock. Very nice reactions here on the Wednesday when most of the market was making their highs. Certainly the S&P 500, certainly a lot of non-tech stuff was making the high, the big swing high. And that level obviously mattered not just once more or twice more or 3 times more or 4 times more, but even closing there magnetically, weekly R1 and that untested gap fill, obviously the gap filled, but a really solid level there in Apple. So what else is everybody was jawboning about the 61.8, and everyone was talking about that. Why aren't people talking about semiconductors? One of the driving forces, one of the big pistons in the engine of this indefatigable bull, SMH was coming up to its weekly R2 where the swing high was made, right? And what else is at the weekly R2? Remember, we're not taking trades based on one piece of evidence. We want confluence. We want layers and layers of evidence to put the probability in our favor. So if you look closely, and I'm gonna use this globalized feature again, there's an untested close up there. The session March 4th, 2020 had an untested close gap fill, 138.83. So let's just mark that line to make it easy on us as idiots. And you can see up here, it Confluence there. So at the same time, so you have Confluence, if we're zooming out, you have Confluence in this one instrument with 2 pieces of evidence, confluencing with other instruments, the ones we just went over, SPX, IWM, RTY had an extended trading hours high that had been untested in cash hours with the IWM weekly R4 I just showed you, Apple that we just went over on the last chart, semiconductors and so forth. So then you're getting confluence both in those individual instruments as I've just shown, but also across the instruments. Okay, so moving on in real time, so it's Wednesday, and earnings fire off, right? You get a bunch of earnings after hours. So let's take a look at some of the behavior on earnings with our levels and see if, you know, how well they worked or not. So here was Facebook after hours on Wednesday. You can see it ripped up to its quarterly R1 after holding the 200 SMA on the little fake out dip, fading really nicely. That's going to be the high in a lot of tech and Facebook there. Microsoft also after hours on Wednesday popping on a nice beat. Where did it go? Its weekly R2, the same pivot as multiple of these other instruments, just several hours forward in time, obviously on exogenous input here, earnings. Weekly R2 kind of killed Microsoft, didn't it? Where did it go? Back to weekly R1. Tesla kind of off in its own universe, of course, but look at the levels. The initial fake out dip down to monthly R1, annual R3. Where did it go? Quarterly R1. Tried to hold weekly R3, failed. Where did it bounce? Weekly R2 and right back where it started. And you remember that gap fill in SPX that we were talking about that never hit in the cash hours, back to this original screen. Well, obviously after hours on Wednesday, the cash indices were closed. But as you guys know, ES trades round the clock, and so does via TD Ameritrade SPY. And if you look where SPY went, so where SPX went, even though it wasn't trading, where the E-mini futures went, it went to that key level I started this video out describing. Weekly untested close gap fill and the annual pivot points. I don't know exactly how big of a fan I am about the TD Ameritrade 24 hours of trading of ETFs or what, you know, the merits of that I'll let you guys argue about, but it's there, the level was there, and we did go up and just cheeky in a quiet evening on Wednesday, and we did get that magnetic huge level. So the fade really starts obviously Wednesday night. Most of the markets headlines being digested Thursday. The fades continue during the day and morning. Kind of a quiet-ish session, but certainly downwards leaning as the markets obviously didn't want to make big higher time frame money or OTF, not deploying capital in advance of the beating heart of these markets, Apple and Amazon reporting after the bell. So here's Amazon's earnings after the bell. Looks like an initial move up to a weekly R1 and quarterly R2, just a few ticks shy there before dumping down and holding weekly S1 to the tick. And here's Apple side by side, an initial move up. Where did it go? Monthly R1 Big reaction down. Where did it stop? Weekly R1. Some other things, all confluencing, guys. Here's that ES chart that I mentioned with the SPY hitting annual pivot point. There's the E-mini futures. You can see getting the 50 weekly EMA we talked about at the beginning, getting the untested weekly gap fill or weekly close. That's to the tick, literally there, to the cent on the E-mini. NDX at the highs we just talked about, the close on Thursday, so before Amazon and Apple report their earnings that I just showed. NDX at both an untested gap fill, these yellow dashed lines here, and a swing high that was not tested. So a little supply zone there, held, and you can see the next day, Friday, a gap down and fade on the NASDAQ. RTY, the Russell 2000 at the highs there. That's Wednesday and Thursday's high. You can see the daily candles, two interactions there is the higher time frame anchored volume weighted average price at the highs there, as well as a nice channel high or channel trend line, if you will. So lots of talk about the 61.8. Even if you're a proponent, it's just one piece of evidence, but we just walked through virtually the most integral and the biggest constituents of modern markets, and they were all at very meaningful and potent levels, not in the same moment, but at the same kind of 1 day, 1.5 day period, including earnings, which I think is pretty amazing. To say that you can game earnings one way or another is kind of a fool's errand, but does price respect the levels confluentially on the earnings movement? And you can see there, it really did. So that's the big confluence sell. I don't know how many we went through, maybe 15 big pieces of evidence there on that swing high. So just to run through a couple more individual examples from the week, just to kind of go over. And the topic I really want you to send you guys into this next week, kind of thinking about as we cover some of this stuff, is what kind of trader are you? Signals. The most important way to use a signal is to decide what its intended use is. Am I a day trader? Am I a swing trader? The best levels and the best zones in the world aren't going to do you much good if you don't have that part of the between the ears game figured out. Because the road you don't want to go down is, if you're a swing trader, managing a swing trade like a day trade, whether it's not scaling into it or taking heat when price is just coming into another logical level, or if you're a day trader and too patient with a swing mentality, or not taking profits. We call them chunks, multiple dollars a share chunks from a key level, but that could be retraced, and in a trend especially, the instrument can continue higher or lower. The chunk was there for you if you were a day trader, but are you mismanaging that trade with a swing mentality? So what am I? I've got signals. That's great. You've got levels. Awesome. That's step one. Step two is, what kind of trader am I? Who am I? Who is the human being? Who is the style? What style of operator am I when I sit down in this chair and work these signals? Super important, and I find a lot of the errors and frustration and heartburn in this business comes from getting that one little question wrong. I'm a day trader managing my trades with that set of expectations and rules and parameters, or I'm a swing trader and managing my trades with those expectation rules and parameters. So just run through a bunch of quick individual examples. BYND on Monday had a really nice sell signal. You can see we gap up. We come just shy of quarterly R1 here, just shy of it. May have even hit pre-market. This is the 200-day simple moving average, this blue dotted line. And what else was there? If I draw an anchored VWAP from the swing high, that was in play here. That is there basically with the 200 simple moving average. In fact, I think they have the same value. But furthermore, if I anchor a VWAP from the IPO of this piece of crap company, Beyond Meat, that is to the tick at that high. Let me get my arrow. That's to the tick of that high, so that would have been right there. So quarterly R1, 200 simple moving average, and double anchored VWAPs there for a really nice multiple dollar a share sell. Where did it go? Gap fill. And I'm going to use this little globalized thing again. Went to gap fill. I'll mark with a little line there. and the weekly pivot point there. So that's the logical place to cover and take your chunk. If you're a swing trader, obviously you got to sit through quite a bit more for your eventual resolution, which would have been on Friday at the monthly pivot point is finally where it came to rest. This was also just shy, not just shy. This would have been a perfect anchored VWAP and monthly pivot point. So what kind of trader am I? If you're taking this long, weekly pivot point and gap fill, that's multiple dollars a share. That's $4 a share. It looks like nothing on this chart, but for $4 a share on 500 shares is $2 grand. On 3,000 shares, you know, this is real money. But you would have been frustrated if you had a swing mentality and thought that that was some kind of epic swing long and beyond meat with 2 pieces of evidence versus this one with 5 pieces of evidence. That led to a swing, but it's a different parameter. You have to sit through 3 days to get to this next level. So what kind of trader am I? Am I taking chunks out of the market level to level to level to level, or am I looking for a big picture idea? There's no right answer in a vacuum. The right answer is in you, right? Moving on, ENPH had a nice swing trade idea. At least that's the way we treated it with, I think it was 7 pieces of evidence. So if you look here on Monday, so this is ENPH coming down into the 20-day exponential moving average, the white line, the 50-day exponential moving average, the black line. It's weekly pivot point. It's also a quarterly pivot point. It's just obscured. There's a monthly pivot point there as well. It's monthly S1. Can't see it. There, you can see the little peach outline. It's also quarterly. It's quarterly pivot point. So 6 or 7 huge pieces of evidence there. You had 2 days to get into that trade as it bounced and digested those levels before it continued higher. Pretty stunning there. Facebook, and this is again wanting to illustrate the concept of having to decide what kind of trader you are. What am I looking for from various signals? Am I looking for bigger picture multi-day signal resolution, or am I taking chunks out of the market at every level, which is kind of our tendency or our answer. You can see I have a globalized anchored VWAP there in Facebook. So Facebook on Tuesday, if you anchor a volume weighted average price, on Tuesday we come down there, which is there. I'm going to zoom in there. So that anchored VWAP down there, right here, is right there. That if that was globalized on that, that's where that held. So as a day trader, again, that's $1, $2 a share, but it's just a blip on the screen from this zoomed out perspective. Now, Facebook ultimately then went down to its weekly pivot point before continuing higher multiple 2 days in a row. Huge up move. The calls no doubt paid huge. So this is where a swing trader, if you're a swing trader and you're treating this as a big level with a higher time frame anchored VWAP and then weekly pivot point, you can't start in here and be frustrated when price goes down to its natural next level at weekly pivot point. There can't be any heartburn. You can't be close to be taking a stop. Obviously, the correct way to approach this would have been half in at the swing anchored VWAP from that swing low, half in at weekly pivot point. You could have even scaled, expecting annual pivot point. So it's just treating these trades. Are you getting the chunk at a VWAP and then moving on, and then the chunk at weekly pivot point and so forth? Here's the chunk at weekly R1 and MR1, here's, and so on, or are there bigger picture ideas? And just making sure you kind of police yourself in managing accordingly. So Netflix, and we'll be all done here, kind of same idea. So Netflix on Tuesday, the 28th, guys, comes down here, you can see, to the 20 exponential moving average. Now, again, are you taking a chunk at this? It's also an anchored VWAP. I don't know if I'll remember exactly which one. If we draw from a swing low, it's that right there. So here you guys can see anchored VWAP there. You see how perfect that is? That is right there at those lows. 2 pieces of evidence. Now, if you're a chunk trader, that's $4 a share, $3 a share twice back up to the weekly pivot point. If you're a swing trader, it looks like a blip on the map. Why? Because price wanted to go to its next logical level lower. Look where Netflix gaps down. How many pieces of evidence down here? Weekly S2. There. This is the Wednesday low, guys. Gap down and push. What else was there? Now, if I just draw a simple breakout line on all these highs, February and March highs in Netflix, just draw a simple vertical line, you can see that also, and I'll just globalize that so you can see that on the other chart. You can see that blue line to the tick hit as well. So weekly S2, breakout retest, and weekly S2. So as a swing trader, you have to have a plan. If you're starting in here, why wouldn't you be more opportunistic or happier when price came down to a huge breakout retest? And this is also just above a swing anchored VWAP. So if I draw a swing anchored VWAP from the March 17th lows, you can see it didn't hit. It would be glib to say it did, but it came darn near close. So as a swing trader, if you're participating here, you can't be frustrated or stopped here. You have to be backing the truck up there with 3 or 4 or 5 pieces of evidence lower. Versus the chunk trader, you better be out. $3 a share, you made your profit, book profits, and moving on. So the rest here, BABA. This April 28th low here is weekly S1. And a meaningful anchored VWAP. If I draw from the March 23rd low, you had this anchored VWAP. Looks like it was materially lower, but in the region, you had quarterly pivot point and weekly S1 there for a nice low as well. Zoom on Wednesday. Comes down. Just a blip on the screen now, but from a chunk trader perspective, you're getting $4 a share from 20 EMA and the anchored VWAP. See you guys here. That anchored VWAP from the swing low in very, very early April is the same moment there. From a swing trading perspective, you can see Zoom needed to go lower, needed to interact with another anchored VWAP down here. In fact, I think it's from there. If I draw an anchored VWAP there, yep. You can see price made its way lower to get to that anchored VWAP. But in real time, anchored VWAP from this swing low was right there with the 20 EMA. Not a great swing trade entry, because that's the way the market chose to behave, but that's $5 a share on a chunk, just back to this little exponential moving average you can see there. And the last one is AMD, I think was a good example. On Wednesday, another one where it's just kind of a concept of decide what sort of trader you are. So Wednesday here, AMD comes down to the 20-day exponential moving average in white there. What else is there? Draw an anchor view out from this April 3rd low. A bit blip on the screen if you're a swing trader. But that is that's over $1 a share, and I remember distinctly AMD went up into the 54s after hours, not seen here on a regular trading hours chart. But 2 pieces of evidence there with anchored volume weighted average price and the 20-day exponential moving average. Chunk traders taking the signal are getting $1 a share per. Happy. Go home and kiss your wife in cash. A swing trader needs to be more thoughtful and just always asking ourselves, what kind of trader am I stylistically? How am I approaching these signals? Step 1, have the signals, look at something confluentially. Step 2, get it right between the ears. Who am I when I sit down in this seat? And a lot of profitability opens up when you can come to the market with that thing figured out. So hope this helps. Have a great week.